Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include the Guild Bayview deal and its repercussions, my interview with Finastra's MaryKay Theriault on where AI can truly strengthen trust, personalization, and underwriting efficiency without over-automation, and what we're seeing in terms of global bond yields with a little scare emerging out of Japan. Whether it's applying to rent an apartment or take out a loan, today's approval process is full of blind spots and inefficiencies. Critical data sits locked inside documents, leaving companies with an incomplete picture that causes delays, increased risk, and inconsistent decisions. 2Dot's ambition is to build a better system, one where underwriting and screening is automated, not manual, where applications happen in real time within a dynamic and contextual conversation, and where better decisions are made faster for everyone. Unlock unstructured financial documents, which unlock smarter financial decisions today by visiting 2dots.net. T-Mobile and Sprint have finally agreed to a massive merger deal. I tried to join the celebration, but there was no reception. There's no reason to think that mergers and acquisitions among companies involved in residential lending will stop in 2026. In fact, I've heard that the 2025 M&A market will provide us with more deals than the previous 2 years, despite the market improving in the second half of this year. It's not an M&A market of only weak companies selling, and the best example of that is the Guild Bayview deal, which closed Friday. Guild completed its 5-year run as a public company with adjusted net income of $47 million in the third quarter, the second quarter in a row above $40 million of income, which demonstrates the strength and success of the company's distributed retail and retained servicing model. The recent performance included its best origination volumes since 2021 and a servicing book of over $100 billion. A great example of two strong companies doing a deal. Terry Schmidt, Guild's CEO, said, quote, "Joining Bayview's platform strengthens Guild's commitment to grow our national brand, and it creates one of the strongest and most compelling mortgage origination and servicing ecosystems in the nation. The Guild leadership team is excited to bring our expertise in distributed retail origination, retained servicing, and the Customer for Life business model to the MSR fund. This relationship will further enhance our mission to deliver the promise of homeownership in communities across the country while fueling innovation and long-term growth." End quote. Joining Bayview, Guild will have access to new capital that is expected to accelerate its growth and investment in product innovation, competitive pricing, increased servicing retention, where Guild is already best in class, and technology enhancements for its origination platform. Guild will operate independently with the existing management team remaining intact, but being aligned with Lakeview Loan Servicing and Bayview's portfolio will create additional opportunities for growth, as the two companies can now leverage each other's strengths in distributed retail origination and loan servicing to create an even stronger Customer for Life flywheel that will be attractive to sales teams looking for long-term growth and stability. Partnerships will continue as well, the latest example being Keller Williams Realty Atlanta Partners, the largest real estate franchise in the state of Georgia, announcing an exclusive strategic partnership with the Southeast Mortgage of Georgia, Inc., or Southeast Mortgage, the largest non-bank mortgage lender in the state. Through this alliance, Keller Williams Realty Atlanta Partners and Southeast Mortgage will empower AI technology and class-leading service to consolidate the buyer and seller process into one seamless experience, eliminating common pain points in the current buyer or seller journey to create a more connected real estate transaction. For today's interview, I wanted to welcome to the show Finastra's MaryKay Theriault to talk about where AI can truly strengthen trust, personalization, and underwriting efficiency without over-automation, and how the evolving intersection of tech adoption, credit policy, and market structure should shape lenders' preparation for the next lending cycle. She's Director of Product Management in the Mortgage Division, where she's responsible for the strategy and direction of Finastra's industry-leading mortgage solutions. With over 20 years at the company, she brings comprehensive mortgage lending knowledge and industry expertise.
The whole goal, for lenders at least, is to create more modern, customer-centric experiences. So it butts up against how much should we automate, how much should we keep the human in the loop, what's the best interaction between the two, and it shouldn't be one versus the other. It should be how do they work together symbiotically. Where do you think AI can genuinely enhance trust and personalization, things that maybe it hasn't historically been known to do? And where do you think the industry still risks kind of over-automating moments that require human judgment?
Yeah, so AI can enhance the trust by making the process faster, more accurate, personalized. For example, you can use automated data extraction and intelligent workflows so that borrower is going through a application path or, getting relevant questions to their experience and not waste time. I think where you still need that human interaction is those more complex transactions that require a human judgment or the human judgment to the transaction. You can't over automate because then you risk losing that trust in the borrower, right? Especially like your first time home buyers that they've never been through it before. If you have everything automated, they don't trust you. They need that interaction.
Mhm. They certainly do. And I think we're seeing kind of a stratification of how can we as a lender quickly identify just how much help people want? Do they want high touch? Do they want low touch to breeze through the process? Do they want to talk to somebody? So I think companies are getting better. Let's stay on the topic of automation though, because underwriting and document review have kind of been held up historically as the prime areas for automation. But over the next year and a half, what specific parts of the process do you feel like AI can meaningfully transform, maybe outside of underwriting and document review, which seem to have come a long way? And then any parts that you think will remain kind of stubbornly manual despite the hype?
Yeah, I think AI can transform the time-sensitive tasks like document handling, income verification, statement analysis, condition clearing, right? You can automate as documents come in, you can automate that clearing of conditions. Tools like Finastra's MortgageBot LOS, we can automate the pre-pop of credit reports, mortgage insurance rate quotes, all your verifications, asset income verifications. It's going to help reduce those manual errors and accelerate those time to close. So really bringing up your, increasing your margins that you're going to make on a loan. Today, margins are so thin. So if we can automate those processes, we can increase those margins and we can close loans from into hours from days, right?
Mhm.
So manually oversight, it remains critical in those atypical borrower situations, maybe your non-conforming loans or non-QM loans. There you're going to need really that human manual process to remain in there to help make those credit decisions.
We've seen here over the last year or so big national lenders making plays to get the top of the funnel, get the servicing component, kind of this end-to-end of the process. And so I think smaller or mid-sized IMBs out there are going, how can we compete with these guys? Because obviously there are advantages that smaller IMBs still have. Maybe they're more nimble or whatever. But when it comes to kind of these AI-driven workflows, what advantages are there for smaller and mid-sized lenders that maybe national competitors don't have?
Oh, I don't know if the national competitors don't have it, but I definitely think that those smaller lenders can take advantage of the AI, the workflow automation. I always used to call it, or still do call it, the stare and compare, right? You
Mhm.
get all those documents in, and a processor has to stare and compare and make sure that what the borrower said in their application is really um, the what's real, right? So that stare and compare. By using workflow automation, smaller lenders can take advantage of that, freeing up their staff then to focus on the relationship building and the portfolio growth. They can use predictive analytics to identify refinance opportunities or their underserved borrower segments. So there's definitely things that AI and workflow automation can help those smaller institutions stay relevant and compete with those big national lenders.
And obviously, tech out there is a huge tool for companies, but leveling that up one step, how can companies turn it from a tool into a strategy?
Yeah, that's a tough question, but I think, lenders using technology strategies can help them embed AI and that automatic decision making right into their portfolio, not just the operational tasks. Interesting enough, we had our user conference this last week in Orlando, and those smaller institutions still don't know how they want to bring AI into their strategy. They're going to be slow adoption into that space. A lot of it is around compliance, how their compliance departments or their legal or IT department are looking at AI. They're really hesitant to jump into that space without really just taking it slow and getting their feet wet.
Can we dive into that a little bit? Because I want to talk about the intersection between tech adoption and kind of credit policy evolution that you mentioned there. Where do you see the intersection, taking into account the structure of the market as well? What are prudent ways to think about it?
Yeah, I think as we get into 2026, I think to really be relevant and scale, our smaller institutions have to balance it. They have to jump in, be on a cloud-based platform that has workflow automation so that they can handle more volumes and the spike in volumes. Hopefully rates are going to go down, right? We all anticipate that we're going to still continue to come down a little bit, get into that refinance market again. And so they have to embrace AI and use it in their underwriting and document automation so that they can support closing loans faster, doing more volume with less overhead. Over the past few years, lenders have laid off people. So we need to be able to do more volume with the same headcount that we have today.
And finally, before I let you go, let's talk kind of how people should be strategizing here a little bit or preparing, because there's this gulf that's emerging between the haves or the users of AI and advanced technology and the haves not or use not. I need a grammar lesson. But anyways, when it comes to this, how should lenders prepare to avoid being left behind as kind of we move into a little more favorable market cycle here?
Yeah, lenders need to invest in a scalable AI-driven system now. They need to focus on that automation so that they can do high volume, repeatable tasks, and then use predictive analytics in their portfolio to gain insights. That modern digital mortgage platform, like a MortgageBot LOS, can help them accelerate their revenue recognition, improve their customer satisfaction, just reduce that overall processing cost. So teams need to prepare now for what's going to come in the future. And if they don't, they're going to be left behind.
Yes. So hopefully they're listening to this podcast for some good little tidbits. You certainly gave a lot today. MaryKay, I really appreciate the time. Thank you very much.
Yeah, thank you, Robbie.
Interest rate wise, bond yields rose yesterday after a sharp sell-off in Japanese government bonds, triggered by the signal of a likely rate hike that pushed Japan's two-year yield above 1% for the first time in 17 years. With money market odds of a December Bank of Japan move jumping, global yields moved higher on worries that Japanese rates could pull capital away from treasuries. In the U.S., factory activity fell in November by the most in 4 months as orders weakened, indicating manufacturers are struggling to break out from an extended malaise. The Institute for Supply Management's manufacturing index eased further into contractionary territory. The measure has been below 50, which indicates contraction, for 9 consecutive months. Today's economic calendar supposedly includes the release of the delayed August JOLTS job openings at the state level. The national level was released in September. Markets will also receive Redbook same-store sales, some short-duration treasury auctions, and despite the Fed being in its blackout period ahead of next week's FOMC meeting, Fed Vice Chair for Supervision Bowman will testify on oversight of financial regulators before the House Financial Services Committee. We begin Tuesday with agency MBS prices unchanged from Monday's close, but certainly worse than last week. The 2-year yielding 3.54 and the 10-year yielding 4.11 after closing yesterday up 8 basis points to 4.10%. Let's wrap up with a joke and some housekeeping. There's a young boy living near the border of Venezuela who's a well-known troublemaker and was well-known with the police and the customs officers. One day, he's crossing from Colombia to Venezuela on a bicycle with 2 bags of sand on the back of his bike. The custom guard knows this boy well enough and is 100% sure that he's up to something. They suspect the bags are filled with contraband, and so He asks to open up both bags. It's nothing but sand. So the guard lets the boy pass. A few days later, the boy passed through it again with 2 bags behind his bicycle. Still nothing was found. This goes on for several days per week, but the customs guards never find anything, frustrating them. After a few months, the guard saw the boy in the park and sits beside him. I believe you're up to something, but we just cannot find anything with you. For the love of God, can you tell me what you're up to? What are you smuggling? I promise I will not catch you when you pass through the borders. Please, just tell me. To which the boy replied, bicycles. Thanks again to Two Dots for sponsoring today's podcast. Their conventional screening agent replaces manual underwriting with a streamlined end-to-end process that reduces risk and fraud while securing safer borrowers, increasing profitable loan volume, and lowering underwriting overhead. Learn more at twodots.net.